Yes, and for today, we are now looking at chapter number 2 of financial management, which is all about the financial environment. We want to study the financial environment, and after studying the financial environment, the key things we will look at, we will understand what financial markets are, and after understanding financial markets are, we will understand what financial intermediaries are. We will understand how the financial markets work. We will understand the key roles that are played by the financial intermediaries. And later on, we will look at the different forms of market efficiency. And what does it mean when you say the market is efficient? Basically, those are a few things that we're going to focus on today. So to start with, the financial system, actually, it constitutes of a number of, financial institutions and the market serving businesses, business firms and individuals and governments. So you find that when you sum the governments, the individuals, the firms, the financial institutions, once you put them together, you produce what is known as the financial system. That's a financial system. It's a system as a whole. Now a financial market on its own now, it comprises all the institutions and the procedures for bringing the buyers and sellers of financial instruments together. So that is what the financial market is all about. Okay. It is actually a well-arranged mechanism that is made up of the institutions and the procedures that should help in bringing together the buyers and the sellers of financial instruments. Okay, and we will talk about the financial instruments in question very soon. So when a firm invests temporarily in some idle funds in marketable securities, it has direct contact with the financial markets. Whenever you invest your funds, okay, in securities, maybe not to be too technical, when we talk about securities here, we're not talking about maybe the security guards or something. We're trying to mean, we're trying to refer to things like buying shares, okay, buying the bonds, buying the government bonds, buying the corporate bonds, buying the security, the treasury bills from the government, all those things. That's what we are trying to talk about. Buying shares from the public limited companies. That's what we are trying to talk about when we talk about the securities, not really the people. So the firms usually use the financial market to raise capital to invest in assets. Okay. So basically what usually happens, sometimes you find that the firm does not have enough capital, right? The giant corporation, like would say a public limited company, for example, here in Zambia, you have ShopRite, you have Zambeef, you have Bata, you have Airtel, you can buy shares in the Copperbelt Energy Corporation, CEC, you can buy shares in Taj Pamo's Hotel, you can buy shares in Chilanga Cement, among others, all those giant public limited companies where you can even buy shares from Zanaco. Those are the companies that we're talking about. Now, when those companies really need capital, sometimes they raise capital by issuing out the shares, all right? That is issuing share equity, where people now go and buy shares so that they can become part of the owners of the company. And as you become the part of the owners of the company, what basically happens is that you will share, if you get the ordinary shares, you get to share both in the profit and the losses of the company. So you will have the direct link to the financial markets, okay? So what happens is that the company, as I've said already, they actually raise capital in that way. Whenever they don't have enough capital, that is just by like selling some part of the company, right? You sell some part of the company. Is that clear? Someone can still respond. Okay, thank you.
Yes.
So the businesses must continually actually interact in the financial markets. The financial markets that we are talking about hinges around the primary and the secondary markets. For example, I'm sure people you have heard of Lusaka Securities Exchange, right? The Lusaka Stock Exchange, which is actually one of the key markets that brings together the people that have money, idle funds, of course, and those that need the funds. They bring the investors to meet with those people that want the money, that have got a lot of uses for the money. So you find that Lusaka Securities Exchange or Lusaka Stock Exchange usually facilitates, okay? Lusaka Stock Exchange facilitates the buying and the selling of shares, okay? And usually sometimes through the registered brokers. Okay, we have got registered brokers here in Zambia. And one of them that we have is Stockbrokers Zambia Limited. They have one of their offices there in Long Acres, just there, here in Swag. So this is what usually happens. So you go through the registered brokers, then the brokers can link you to LUSE, the Lusaka Stock Exchange, that regulates the buying and selling of what? The shares. Okay, if you want to buy shares, you go through that. You want to sell shares, you go through that. Okay, so that's basically what happens. So the market price of a company share or security is the test of whether the company is a success or a failure. So usually we measure the value of the company using the price of the share, because the higher the price of the share, the higher the value of the company. But that is actually sometimes debatable. So you can actually debate that sometimes. Okay, you can actually debate that. So as you can actually debate that, you'll understand and realize that sometimes it is not always that the share price really is telling us the value that the company holds. But usually what happens is that as the company grows, many people get interested in buying shares in that particular company. So the demand of the shares for that company increases. That pushes the price of the shares for that particular company. So that is what we're trying to talk about in a nutshell. So a financial asset is actually created when the investment of an economic unit in a real assets exceeds its savings, and it finances this excess by borrowing or issuing stock, right? So now the interaction of borrowers with the lenders determines interest rates. The interaction of the borrowers and with lenders, actually, that's what determines the interest rates. Okay, so you find that the exchange of funds through investment instruments or security creates financial assets to the holders and the financial liabilities to the issuers, and that's what usually happens. So now, what about financing decision? When I was introducing the course, I did say that there are three key decisions that you will have to study here on how to make them. And to start with, there is what is known as the financing decision itself, there is the investment decision, and there is the dividend decision that is there in the introduction. Okay, so what about financing decision? Shall we talk about it just a little bit? So there are two ways to finance an investment. Two ways. You can use the money for the company, or you can raise money from external funders. Okay. I'm saying that you can use the money for the company, or you can raise the money from the external funders. Okay. Both of them, they have got disadvantage and advantages. They have advantages and disadvantages. Okay. So there are two ways to raise money from external funders. You can either take a debt or you can sell equity. When you sell equity, it simply means you sell part of the company. That is to say, you issue shares. Okay, that's equity. But when you take a debt, you can issue things such as corporate bonds, debentures, among others. As you're going to see in chapter number 6, where we'll talk about business finance, we'll talk about this in detail, right? The different ways of financing a business. Okay, so you can either get a debt or sell what? Sell equity. Now, the loan has to be paid back with an interest. That is if you take a debt as a company. Okay, you have to pay back that loan with an interest, which is actually the cost of borrowing. But selling of shares or selling of equity is essentially selling part of your company. This I've already said. So when a company is selling shares, we say that the company has gone what? Public. Okay. To go public, when a company decides to go public, it simply means they go out and issue shares to the public so that whoever has money and is willing to buy the shares, they can buy. Right now, for example, those few companies that have already listed, they are on public, right? You can buy shares even today in what's this? In Zanaco, in Airtel, all those companies that I have listed, but you can become a shareholder. Actually, it's just something that is not very complicated as people might think. For example, a share, as for today, for Airtel, it stands around 18 kwacha. So you can just buy, 1,008, you can get somewhere around 100 shares in Airtel, just that, okay? So basically, that's the whole idea behind that, hoping that people are getting that. Are we fine? Are you okay? Are you able to hear me?
Yes, sir. I'm able to hear you clearly.
Okay. So the company can decide either to get a debt or to issue out the shares. Now, what is the purpose of the financial markets? What do we say? What could we say is the purpose of the financial markets? Why should they be there? Okay. We say that a financial market is there, okay, to bring the buyers and sellers together for trade in financial assets. What financial assets are we talking about? We're talking about things like stocks. We're talking about things like the bonds, commodities, derivatives, and currencies. I will talk about derivatives but usually you don't discuss this in detail in financial management. There is a course actually in derivatives called derivatives, right? Mostly this course is taken by those people majoring in finance and economics. They do a course called derivatives, but that's under degree level. Okay, but anyways, we will talk about these things in detail. I've already talked about the bonds. I've already talked about the shares. By the way, the shares are also called the stocks. So this is what the financial market does. It just brings together. So you have money that sits idle. You don't know what to do with the money. But there is someone there who is looking for money. They already know what to do. So what happens is that the financial markets will bring together two of you guys. Someone who has money will take their money to buy shares. Then those people that have got companies or the directors of those PLCs, the public limited company, will use that money and in different ventures that they see fit for their business to undergo. Okay. So the financial markets set prices for global trade. They raise capital and they transfer liquidity and risk. So that's all what they try to do. They raise capital. They help also in transferring liquidity and risk. Okay. And someone might be interested in knowing what liquidity means. So liquidity simply means having more assets that can easily be converted into cash with much easy. That's liquidity. Okay, preferably we are saying that the cash is the most liquid assets that we have. That's why in the financial or in the statement of financial position, the balance sheet, it sits under the current assets. Yes, there is a hand from Charlie and is asking.
Yes, sir. I didn't understand on bonds.
Okay, okay. So
Yes.
basically, let me just highlight on bonds. So with the bonds, how they work like this. You have man. Let me start from the government bonds. There is the time when the Bank of Zambia is in charge of that. When the Bank of Zambia says they want to maybe reduce the supply of money from the circulation, so what they do, they issue out the bonds. Now, to issue out the bond, it simply means that they are going to say anyone who has money, let them bring their money here. We use their money. We give back their money with an interest. Okay, there will be an interest that will be added to that money. So you basically take your money more like saving. So you give your money, then there is some form of certification, some paper where you write, you sign that no, we have gotten your money, and we'll give you your money at this time, okay, or after this period of time with an interest of of this rate. Okay, that's a bond. So you go back home, you have left your money there, you just remain with the records. When that time comes, you receive your money, especially when the bond matures. That's how the corporate bond works. That's the government bond. Even the corporate bond works like that. Companies, these giant companies do that. They issue out the bonds, then people go to buy bonds. You go to buy a bond, okay? You buy a bond. When you buy a bond, simply means you take your money, you leave your money there, then you get the documentation or the writings and you keep. So that when the time comes, you just get your money with that. Did you get that?
Yes, sir. Thank you.
Okay. The capital asset, the capital markets now. So the capital markets are peradventure the most widely followed market. So the capital markets, under the capital markets, we're talking about things like the stock, the bond markets, okay? The stock market and the bond markets are usually closely followed. Okay, their daily movements are analyzed as proxies for the general economic condition of the world markets. Now, just like the movement of shares, the share prices, no one has power over that. Like the world market determines that. It's just like the exchange rates. That's why you find that the share prices can change even one day, within a day. Similarly, the movement of exchange rates, you see that maybe the dollar yesterday could be at 19. Today, you can still find it at 21. It's possible. The world market regulates all those movements. Okay. So, but how it does, that's another serious and advanced conversation, which is not part of the scope of your course. Just get that. And so the institutions that operate in the capital markets, they involve the stock exchanges like Lusaka Stock Exchange you've heard, commercial banks, and all types of corporations that include the non-bank institutions such as insurance companies, mortgage banks. They are usually carefully scrutinized. So those are institutions that are involved in the capital markets. Okay. Yeah, in the selling of bonds, sharing of the bonds, issuing of the bonds and the issuing of shares. That's what you're trying to talk about. Those are institutions that participate in the capital markets. They involve the stock exchanges, the commercial banks, and all types of corporations. They include non-bank institutions such as insurance companies and mortgage banks. Yeah, and usually they are carefully scrutinized. Did you get that?
Yes, sir.
Hello?
Yes, I will do.
Now, institutions, they access financial markets to raise capital for long-term purposes, such as, why should the company go to raise money, to raise capital? Capital for what? That's a question. Capital for what? Right? So the institutions would want to go and raise capital for the following. Number one, for a merger or an acquisition. Could you tell me the difference between a merger and an acquisition? What could be the difference between a merger and an acquisition? Anybody? All right. So with a merger is it occurs when the companies that sell the same product, almost the same vision, come together. They merge together. That's a merger. Okay. So you can have the money, get the money for a merger, so that you can merge with other companies. An acquisition is when you buy the entire company. You know that the companies can be bought. You know, these small companies, when you see that what they are doing seems to make sense, you can just buy the whole company, buy the product, buy everything. You know, it loses its identity. And usually serious companies have had that tendency. For example, the trade kings have been doing, have been buying small companies, and you stop existing. You lose your identity, like your identity, you no longer stand as your own, right? Like you no longer stand independent. Did you get that? Okay. They get the funds to expand the line of business, to enter into a new business, or for other capital projects. Those are main reasons as why firms gain firms or corporations, the PLCs to be specific, you know, gain capital. What are some of the ways by which long-term capital is raised? Long-term capital is raised, okay, you know, through the bonds. I've already said through the bond market, where the company issued debt in form of corporate bonds, okay? The local and central governments may issue debt in form of the government bonds. I've already said that. The bond from the government is called the government bond, and that one from the corporations, from the corporations, the public limited companies, those bonds are called corporate bonds. And the companies may decide to raise money by issuing shares. That's issuing equity, okay, to the stock market. That is what they do. So basically, when you see that, for example, Zanaco is selling shares, they want shareholders, ShopRite, just know that you, as someone who understands, they are raising capital. They are raising money. Maybe they have giant projects that they want to undertake or to embark on. So they have insufficient money. So they're trying to raise money. It's a way of raising money. Have people buy shares. So we want your understanding to change. So there should be a paradigm shift in the way how you look at things. Okay. So is there a question or something? Okay. We can proceed and
Okay, sir.
yes, sir.
On the shares, you share the profits and losses. Do you also share the profits and losses on bonds?
No, the bonds is a debt. There is nothing like sharing the losses. Actually, it is not shared because it's fixed. You get. It's just more like you say when you buy a bond, you just take your money, more like you say. They promise, okay, we'll give back your money with an interest of such, maybe with 10% interest after such a period of time. You get this, you sign some forms of agreements. That's how it goes. When that time comes, you should receive. It's a debt, like the company gets a debt. It starts owing you. It's more like the company now owes you. It has to pay you back. But with ordinary shares, it's a different scenario because when they have made a loss, you are part of the owners. They will just report that the director of finance, DF, will just come and say, no, this year we really made losses. We didn't operate well. And you, as part of the shareholders, you keep quiet. What can you say? Like your business is your business. When you buy shares, for example, in Zanaco, Zanaco become yours. Like you are part of the owners of Zanaco. You get it? So when Zanaco has made a loss, you have made a loss as a business. And that's why there is a very serious conversation. If you want to buy shares, you really need to consult from people that have got understanding in these things better. And especially people that have measured well in finance, that have done higher studies in finance, so that you can analyze the companies very well. You don't just wake up and say, oh, I'm going to buy shares today in ShopRite, or I want to buy shares in Airtel, I want to become a shareholder. No, the thing is that the way how you're choosing those companies, you should be guided by understanding and theory and plus much reasoning, okay? So someone who is a specialist in those fields, of which I might be one of them, of course, you can find out so that we guide you properly and we can analyze, we know their behavior, we know how to analyze the trends of those companies because we are trained how to analyze financial statements and all those things, all those subjects around that. That's our field of study. Is that clear?
Yes, sir. Clear.
Now, if the securities have already been issued, they are now being traded among buyers. This is done in the secondary market. That simply means when you go, you buy shares, for example, in the Airtel. Then after some time, you say, I'm no longer interested in holding the shares in Airtel, right? You want to sell those shares. Just go to the broker. For example, if you want to, your broker is Stockholm Brokers Zambia. They are in Long Acres. They also have an office in Long Acres. Just go there. You tell them that, me, I want to sell the shares. How many? Of course, if they are your brokers, sell your shares. Then those shares are now traded among investors, right? You are an investor, you have sold the shares so that another investor can actually come and do what? And buy those shares, right? So that market is called the secondary market. Whereas when the shares have just been issued, they are traded on a new market, and the market is called what? The primary market, when they've just been issued, okay? Is that clear?
Clear, sir.
So many investors, they usually access the capital markets for save, to save for retirement, to save for education, as long as the investors have long time horizon, which usually means they are young and are risk takers. For example, if you are planning to go for a master's and you're still in first year, maybe you're still just in first year, you're planning to go for master's, you want to save your money, you can maybe invest your money in shares, you can buy shares, and so that you keep your money. It's just more like way of saving. You leave your money in shares, you buy shares maybe in any of your companies that you're interested. But it's apparent that, like right now, the Copperbelt Energy Corporation in CSC is happening well. It's doing a little bit fine, and their shares are gaining in price. I was just analyzing that yesterday and how the trends are moving. Anyways, away from them. Any question? Okay, let's look at the money markets now. The money market. So the money market is open accessed alongside with the capital markets, okay? So the money markets are used to access funds that are needed in a shorter time period, usually 1 year or less. That's the money market. The capital markets is when you need the money for a long term, okay? But for a shorter period, that is usually less than 1 year, 1 year or less, you go to the money market, okay? Interesting, it is enough to learn that the financial instruments are used in the money markets. And these would include the deposits, the collateral loans, the acceptance of the bill of exchange. Actually, I will speak loudly when we go to business finance in chapter 6, because the whole chapter is actually dedicated. It is dedicated to the study of business finance, how to finance the business. Where do you get money to finance your business? Actually, so we'll look at the different types of money, types of money, like sources of financing. We look at the short term, the medium term, and the long term. Those, and we really have a very compounded study. So most of the institutions that operate in the money markets are central banks, the commercial banks, the acceptance houses, among others. Now, what are some of the functions of the money markets? The main function is to provide liquidity. They provide liquidity. I've already said what liquidity is. So the short-term debt is issued for a purpose of covering the operating expenses or the working capital for a company or a government, or not for a capital improvement or large-scale project. So you don't usually get to the money market if you want a lot of money, and that's for a long period of time. Usually you go to the money market just for if you want money for a short period of time. Okay, yeah. Now, who are the financial intermediaries? These are the entities, right, that act as the middleman between the two parties in the financial transaction, such as the commercial banks, the investment banks, the mutual funds, and the pension funds. Okay, they just act as the middleman between the two parties in the financial transaction. Okay, I've already given the examples. They include the commercial banks, the investment banks, the mutual funds, and the pension funds. The financial intermediaries, they offer a number of benefits to the average consumer. The benefits would include safety, liquidity, the economies of scale involved in the commercial banking, investment banking, and asset management. So those are some of the benefits that the financial intermediaries give. I've said the benefits include safety, liquidity, economies of scale, investment banking, and asset management. Okay, is that clear? Yes, sir, that is clear.
Yes,
what
sir.
about the secondary market? The secondary market is where now investors buy and sell securities that are already owned, right? There are those securities that I've said already, there are those shares that they have already been bought. You have them already. So there is that market where you do the transaction, the trading of the shares that have already been owned. That is called the secondary market. And we have the examples. We have the Lusaka Securities or Stock Exchange, LUSE, here in Zambia. You have the New York Stock Exchange in the USA. You have NASDAQ, and among others, there are just many. I'm giving examples of the securities exchange or secondary markets. What if you are interested in comparing the primary market and the secondary market? Okay, so a company issues the stock or bonds for the first time and sells those securities directly to investors. That transaction occurs in the primary market. Okay, when a company issues the stock or the bond for the first time and decides to sell those securities direct to the investors, that transaction occurs on the primary market. Okay, now the most common and well-publicized primary market transactions are initial public offerings. Now, during the IPO, a primary market transaction occurs between the purchasing investor and the investment bank that underwrites the IPO. And usually the proceeds from the sale of the shares, or, on the primary market, they go to the company that issued the stock. Okay, yeah, that's what usually happens. So you buy shares, you are just buying through the market, but that money, actually the proceeds, they usually go to the company that issued the shares because they're the owners of the shares. What about treasury functioning? The general mission of the Treasury Department is to manage the liquidity of a business. As a Treasury Department, you could still call it finance. They monitor current and they project the cash flows, the inflows and outflow. Okay, They ensure that there is sufficient cash for to fund actually many operations. The company operations, they ensure that there is excess cash, and the excess cash is properly invested. The treasury functioning ensures that existing assets are safeguarded through the use of safe forms of investment and hedging activities. Okay, so in order to accomplish the mission of the Treasury Department, the following activities are the ones that the department has to engage itself in, and they include cash forecasting. They should be engaged in working capital monitoring, in cash concentration, investment, grant credit, fundraising, risk management, bank relations, and the IT system, reporting the mergers and acquisitions. Okay. What about financial market efficiency, which is one of the last parts that I said I would talk about when I started? The financial market efficiency or forms include the following. Okay, let's get it like this. When you have an efficient market, okay, then we say that you should have the following. Number one, the price of securities that are bought and are sold, they should reflect all the relevant information which is available to the buyers and sellers. That is an efficient market. No individual should dominate the market if the market is efficient. The hypothesis says that the transaction costs of buying and selling are super low. Okay. We are also assuming, according to the hypothesis, that if a company makes a profitable investment, the shareholders will get to know about it. Now, okay, just for the sake of argument, okay, you see what happens in these corporations. Sometimes they even make profit, but some information is hidden somehow to the, to the shareholders. Like in some companies, there is no super transparency, okay, whereby people are not fully aware, because you just come to the AGM and hear what they have reported. And you find that sometimes you cannot go and audit them yourself. You can hire an auditor, and since you're not in management, they will also hire their own auditor. I'm just talking about some few things that usually happen. They can engage their own auditor, and they collide with the auditor, and then their auditor, they are certified auditors, of course. They audit them, and once the auditor signs on those financial statements, like they are okay, then you have nothing to say, because as you come to the AGM, the director of finance and the team, they'll come and say, all the financial statements are audited, and the auditor is actually certified, and they say there is no stealing, there is no problem here. So you have all those challenges sometimes. But we are saying that in the efficient market, what usually happens is that this problem should actually not be there. When the company has made profit, we should be aware of how much they have made. There shouldn't be cheating. Okay, the directors should not be cheating. If the company make a bad investment, shareholders should find out. And so the price of the share will fall. Now that is in the efficient market, okay? In the efficient market, if the interest rate rise, then the shareholders will want a higher return from their investment. So market prices will fall. Yeah, that is how the markets work. Now, there are basically 3 degrees of the efficient market hypothesis, and they include the weak form, the semi-strong form, and the strong form. Let's start with the weak form hypothesis. The weak form hypothesis of the market efficiency explains the changes in the share price as the result of the new information which becomes available to investors. What we know is that the share prices only change when new information about a company and its profit become available. So the share prices do not change in expectation of the new information being announced. Now, research is usually done to prove that the stock market displays weak form efficiency. Okay. Now, the research to prove that the stock market displays weak form efficiency usually has been done. It's usually based on the principle that, number one, if a share price changes are random, then there is weak form. And if there is no connection between the past price movement and the new price movement, if there is no connection, then there is a weak form. Then statistically, it can be proven that there is no correlation between the successive changes in the prices of a share. That is that there is not, the trends in the price cannot be detected. That is in the weak form. What if you have a semi-strong form? During a semi-strong form market efficiency hypothesis, the share prices reflect, number one, all relevant information about past price movements and their implications. They also exhibit all knowledge which is available publicly. That is what the prices do. They tell us that in the semi-strong. What about in the strong? The one that is strong, the strong form efficiency. When you have the strong form efficiency, it means that the share prices reflect all information available. Number one, from the past price changes, from the public knowledge and the expectations, from insider knowledge about to specialists, available to specialists or experts. When the market is very strong, what usually happens, the financial market, like people are aware of what has happened. All the information is available to the public. Not only that information which should only be available to, you can't hide, in short, that this information is just that special. Like investors just get to know. That is when you have the strong form of efficiency, strong form market efficiency. This is according to the market efficiency hypothesis, three of them. So most of the times, the managers are selected and their main goal should be there to maximize the value, okay, of the investments of the shareholders. That is the main reason as to why they are engaged. In conclusion, we can look at some implications of the market efficiency. Number one, the purchase or sale of any security at its prevailing market price is zero net present value transaction. So the information is actually immediately reflected in the market prices. The assets are not systematically over or undervalued when you have the market efficiency. And the firms should expect to receive a fair value for the securities that they sell. So the fair value is actually the present value of all the expected cash flows with the appropriate adjustments for risk. And over the chapter, I call for questions.